Welcome to MasterMinds, Lessons in Leadership. I'm here with my co-host, Peter Linneman, here, where we discuss the intersection of strategy and leadership at the vortex of what we consider great companies to be great at. And we're very, very pleased to welcome Bill Lenehan, who is the president and CEO of Four Corners Property Trust, an NYSE-listed company. As a frame of reference, Bill was on the Darden board, an activist, in essence got involved in the Darden stock. The real estate was spun out into a restaurant REIT, which Bill now runs after an exhaustive search and by far being the most highly qualified person to be selected. Earlier, Bill was in the real estate private equity business, largely at Farallon, and he also has extensive board experience. He was on the Gramercy Property Trust Board. Before that was taken private by Blackstone, and also serves on the Macy's board. So with that as a background, Bill, and an introduction, welcome.
Thank you.
I will turn it over to Peter.
Well, Bill, thank you for joining us. You certainly have been in an interesting position to see a lot of this unfold with the restaurant portfolio. How have you gone about your strategy formation, and how are you thinking about strategy for the company coming out the other side?
Sure. Well, thank you for having me. And in fact, it was very dramatic. And our stock in the end of March lost more in market cap in about a week than the rent we would have collected from all of our tenants in over 9 years. And within a couple months, we were 99.8% collected and have remained at that high level since. Strategically, COVID was an interesting case because, in essence, it was too late to change strategy, unlike perhaps the financial crisis, where if you were really prescient, you had some time to exit buildings and reposition to other sectors. It happened so quickly that even if you had decided to make a significant change to your strategy, it was in many ways too late. That being said, what we did every day had to change quite dramatically. So we went from being very acquisitive to a 180-degree shift to being focused on rent collection and focused on maintaining our acquisition pipeline. And that was the mode we were in sort of last 2 weeks of March, April, and May. And then by June, we were back to acquiring things. So what I would say is it happened so fast that you couldn't change strategy in the middle. You were left with the strategy that you had executed on, in our case, for almost 5 years going into the pandemic. But what you did every day had to change very dramatically. And I think it was impactful to the culture of the team. We had a small, young team. We were physically all in one place in sort of a condensed office space. And that went immediately to everyone working from home. Marin County, where we're based in California, has been relatively well locked down. And so when COVID hit, we spent the first 85 days, in essence, in lockdown. And I didn't leave my house for a couple months.
So, and just as a follow-on, where are your portfolio properties now? In this sense of not foot traffic, but you know what I mean? Just where are we at?
So I think it's important to recognize that while our portfolio of 800 or so buildings is 97% restaurant, we don't own any chef-owned restaurants. So they're all branded, what people might use the word chain restaurants, but they're all branded restaurants. So they're Olive Gardens, they're Longhorns, they're Burger Kings, they're Chili's, et cetera. And so I would say the quick service part of our portfolio, I would guess, is comping quite a bit ahead of 2019 because of the strength of the drive-thru. And then our casual dining restaurants, which are predominantly Darden, but also a couple $100 million worth of Chili's, are below typically 19, but coming back voraciously. And we actually operate 6 restaurants in San Antonio, which is a little test lab. We get to stay really up to date on how the portfolio is doing. And I would say that they are at or nearly at 2019 levels now. So depending on what part of the country it is in, the cuisine type, whether you have a drive-through, but I, for one, think the economy is going to come back with quite a lot of emphasis.
Well, let's segue to the question of leadership. And by the way, too, I failed to say in my introduction that you are the youngest leader that we have interviewed today, which is either a comment about you or about them. I think we'll go with you for sure. But anyways, you and I have as talked over time. You've always put a big emphasis on the importance of culture and the correlation between culture and business success. Tell us a little bit about that.
Sure. Well, I feel strongly that it starts with recruiting, training, and retaining world-class people. And so we went into the COVID environment with a very cohesive culture, with very, very strong people in what I thought to be the right roles. But until you're tested, and we effectively weren't tested until COVID, you don't know. And so the COVID experience where my team really pulled together, we really took this on. We wanted to be able to return, as our stock price had declined, return to where we had been prior to COVID. And so the team really was pulling hard on all oars. And I think a big part of that was, communication. Having gone through the financial crisis, the thing I learned during the financial crisis was the communication broke down. And so we were really committed to be a culture where we were going to communicate, over-communicate with each other to make sure that senior people were informed and could get guidance, and that junior people who were learning the trade were concerned about the right things, which was the opposite of what I think a lot of people experienced during the financial crisis.
Mm-hmm. Other than communications, what other key attributes of your culture? How would you describe those?
Sure. It's interesting. I probably wouldn't have used this word pre-COVID, but one of the things that COVID really emphasized was, were you prepared? And in our acquisition process, we do a lot of scoring of assets, formally scoring of assets. Every acquisition has a written investment memo, and that was incredibly crucial when all of a sudden in a week, every tenant was trying to communicate with you and figure out what your stance was on lease negotiations or rent forgiveness, et cetera. We knew why we had acquired these assets. We understood what the pros and cons of the properties were, and that was because we had taken the time in advance to be prepared. Similarly, at the top down, our board was knowledgeable about the company. They understood our perspective, et cetera. And so there wasn't a process of, there's a catastrophe going on, and my board isn't in sync with the management team. So prepared was really important. And I think the last thing is that our culture rests on a handful of mental models that we use to approach the business. And just as an example of one of them, we have what we call the heat meter, which is our stock price over time against different valuation metrics. Well, we went from the most in the green we'd ever been with a $33 stock price to the most in the red we've ever been with a intraday $12.50 share price in a week. Okay? And so while that was dramatic and certainly a difficult week to go through, there wasn't any question of what do we do now? Because we had already prepared and said, if our stock is at this price or below, we're going to hit pause. If our stock is at this price or above, we're going to be growing. And that level of preparedness made a huge difference in how we could conduct ourselves and how the board and our investors understood what we were going to go do.
Well, that triggers, Bill, a question I always find interesting, which is you went through the financial crisis in a private firm context. You went through this in a public firm context. If you had the same balance sheet and assets, would your strategy going through it and coming out of it, you think, be any different or not really?
Sure. So I did go through the financial crisis. It was a very challenging time. I think in 2010, I lost something like 70 pounds in a year. It was very, very stressful. We very much didn't have the same balance sheet. So we were investing private equity capital, very high rate of return expectations, 80 to 85% underwritten leverage. And ultimately the deals worked out to be quite good because we had long-term debt and great operating partners. But to answer your question, my role with Four Corners, which we don't use LTV, we use debt to EBITDA, but unquestionably very low leverage. Maybe in a private market context, something like 25% LTV, something along those lines. So from my perspective, and we're investment grade, so have much different sort of access to capital. So it was very different. It was much more outward facing, whereas at Farallon, it was much more focused on the deals, how the portfolio companies were performing, what we could do with the capital structure to buy runway. Whereas with Four Corners, it was much more about managing a team, communicating to investors, communicating to my board, changing our disclosure regime such that we were much more communicative. We already had great disclosure to begin with, but now there was this need to talk about on almost a weekly basis how we were doing. And I spent 10 hours a day, 6 days a week for 2 months talking to tenants and investors, which was very different than what was the case during the financial crisis.
And now you have powder to come out on the other side.
Right. In fact, in the fall of last year, we actually raised some private equity capital from Lupert Adler in Philadelphia to buy vacant properties. And so that's a process that we've been working on for the last 6 months. And so that's just a very different thing to be doing than when I was at Farallon, where it was really focused on here are these portfolio companies, what are we going to do to get every last dime for our investors. And again, they turned out to be good investments. And so it's just a much more dramatic period with IRRs that ended up being quite good. But during the financial crisis, it was very stressful. And I think, honestly, Peter, going through the financial crisis, when I reflect on it, made going through COVID a lot easier. I had perspective on what the opportunities were going to look like. I had some perspective that you are going to get through it at the end of the day, to focus on communication, to focus on the team. And now we're in a period of returning to work that's actually in some ways trickier because it's not a triage situation. It's an optimization. How do you get people back to work where their careers are progressing? And especially in Marin County, we're so close to the San Francisco tech area where a lot of those companies, their business model works perfectly fine with people staying home, whereas ours, is much more of an apprenticeship model where we're teaching the business to younger people, and being in person, I think, is a more productive way of doing it.
So, Bill, you've got a pretty unique perch as a public company CEO. You spun a company out, you took it public, you basically formed a board, you hired a management team, you took it out of the chutes as a public company, now you're a stabilized public company. If somebody was to ask you just about a couple of the key learning moments from a leadership perspective, from the beginning of FCPT to where it is today, what would you say?
Well, I think one of the biggest differences for me now is, I hired a coach maybe a year or two in. That's been a terrific experience. Really learning from someone who's seen many more perspectives than my own. So that's been a really terrific experience. I think, the board that we put together with your help, Bill, significant help, has been a really terrific sounding board. And I think during COVID, it's just really focused us all on being more deliberate. And 30% of my time before was in travel, going to a board meeting or going to an investor meeting or visiting properties or seeing other companies. And that's been significantly reduced. So spending that time really deliberately has been an important focus. And I think the other thing I would say during COVID, March, April, May, June timeframe last year when it was most impactful on our business, I noticed that there were a lot of people that were very negative, and it was almost like they were trying to prove who could be the most negative. And if you didn't agree with their world was going to end, proclamations, you weren't being realistic. And I very much early days in this said, that is just not who I'm going to be. I'm going to be, whatever Pollyanna-ish is, I'm going to be one click away from that. I'm going to be positive, and deliberately positive. And it's been interesting in the last couple of months, I've had people that I spoke to circle back to me and say, you were the most positive person I talked to during COVID. I needed that. My team needs that. Everyone's going through difficult things during COVID. They don't need me to pile on negativity. So being deliberately positive, I think, has been one of the realistic in how we run the business, but deliberately positive, I think, is important. You certainly don't want to be the person that everyone remembers as the most negative.
One of my catchphrases early on was people said, aren't you worried about what happens if you're wrong and everybody's dead? And I said, no, because if everybody's dead, I don't have anything to worry about. We're all gone, and we move on.
Right. And Peter, one of the things I spent a lot of time thinking about in the beginning, is there any aspect of my business that's the proverbial, Humpty Dumpty cracked egg that you can't put back together? And there are some kinds of real estate, there are some kinds of net lease in particular, that might be the case. And I spent really 2 weeks really thinking through this. And there was nothing that I came to that said, I can't put this all back together where it won't be a problem. It won't be a problem if we were to relieve rent for a short period of time. And the reality I came to is that actually my tenants really adjusted quickly and decisively to a more to-go regime, and they were covering their rent quite quickly. So it really was a matter of thinking through, how does this business really work? Is there reason to be doom and gloom? And the reality was pretty quickly that while the human cost is going to be very significant, that from an FCPT business case perspective, we were going to be just fine.
So, Bill, probably my favorite question is, you're a young guy, and I don't know if your parents are still alive, but if they are, if we had them on the phone right now, what would they say they're proudest of?
Sure. So my mother's still alive. My father passed away just before this whole Darden Macy's period of my life. So I wish he would have seen it, but if he's up there looking down, I think he'd be happy. But as you said, I'm only 44, so I've got a long time before I'm writing my memoirs, for sure. Not that anyone would read the memoirs of a net lease CEO. But yeah, I've got way too much in front of me, Peter. Hopefully the best hasn't been done yet. But I do think, my coach, Randall Stutman, who's really been impactful in my life, really teaches this idea of admired leadership, of not just being effective, but being effective in a way that the people that you're working with want to follow you, and not being sort of effective but unliked or sort of achieving results through force or coercion or just compensation has had a real impact. So I think for me, the real goal is not the comp or the size of the company. It's achieving the results the right way, and in my mind, the right way is admired leadership, not leadership by coercion or force or just compensation.
The only thing I can say is that Bill's mother called me after the public announcement that he became CEO of SCPT, and unfortunately, I just can't tell you what she said.
I can tell you she definitely didn't do that. But yeah, it was a period of joining the Starboard-led board, working with the board of Darden and the management team was exhilarating. Working with Jeff Smith, Starboard in particular, and the management team was exhilarating. It was a terrific process. The REIT investor, as you know, has very particular things that they are looking for in companies. And if you don't get that REIT investor buy-in, it's very difficult to get the advantage cost of capital that you need as a net lease company. So we were starting with one arm tied behind our back, right? We were going to be 100% concentrated with one tenant. So it really was an interesting exercise to say, if we got everything else as right as we could get it, will we get the buy-in from the REIT investor? And I won't name them, but I had one dedicated REIT investor based on Park Avenue, right across from Waldorf, if anyone can guess who they are, call me to their office before we did the spin to say, we really don't want this company in the public REIT domain. And I said, wait a second, all due respect, I think I understand what you're looking for. Give me a chance. And they say, well, we're really skeptical. And I think within a year of the spin, they were our largest active shareholder. So it was a terrific, I think, example of, if you get all the other aspects of these companies right, governance, leverage, management, aligned incentives, strategy, et cetera, you can start with one of the dynamics, diversity of income stream in a subpar position. And then for the next 5 years, we've dramatically improved the diversity of income. And during COVID, the fact that we had low rents that were well covered really mattered. In fact, it's hard to believe, but if our math is correct, which we believe it is, Darden, which is about a little less than 70% of our rent roll, is already back to covering our rents by 4 times.
So, Bill, if somebody was to ask you, who was your greatest mentor? What's the most important thing you learned? What would you say?
My board has been really supportive. My coach, as I mentioned, has been terrific. I took counsel from a couple other executives, Ben Shaw, who ran Blackstone's industrial portfolio Link, but also was at Gramercy before that. Ben Shaw, who I know you know, Bill, who was at Seritage. I think, really being my own counsel and thinking through what was it like during the financial crisis, writing that all down and saying what's operative now, and taking those learnings. I have a lot of former Farallon colleagues that I hold in high regard as well. But interestingly, Bill, I don't know if there was the same kind of mentorship opportunity during COVID as there would have been during the financial crisis, right? If you were going through 08, 09, perhaps you could call someone who went through the savings and loan crisis or prior crises, and they could tell you about what the similarities and differences were. There just aren't public company REIT executives who have been through a pandemic, and certainly not public company REIT executives that have been through a pandemic that seemed almost singularly targeting the subsector that I was in, restaurants. So I had a lot of support from my board. I certainly didn't do it by myself, but there perhaps wasn't the same kind of mentorship opportunity as there was during the financial crisis or other more normal way crises.
So, Bill Ferguson, if I could get you to lean to one side or the other, point to, So if you see behind where Bill's head was, it says generosity. Bill Lenehan, how does philanthropy evolving and fitting into your life, and how do you think about it?
Sure. Well, this isn't financial philanthropy, but I guess, time has value. One of the things I've done quite a bit recently, and I certainly encourage others to do because it's been very valuable to me and fun to do, is spending more time with students now. With the power of Zoom, other video techniques, you can teach a class at London Business School, if you have spare time, or your alma mater, or many of these schools now have real estate clubs. And so I think it's a great experience. I think it's somewhat similar, Peter, to what you're trying to do with this episode. is get in front of students. Tell them what it was like running your company for a year that was, unlike any other. It's a great experience. The preparation to come up with a presentation and crystallize your thoughts, write down notes, I found very helpful. Students really like it. It's a terrific recruiting tool. You can be really top of mind for young people. And if you don't do that, I can tell you the opposite is true. That young people on campus can tell if you've been away from campus for a long time pretty quickly. So that's something I've spent a number of times doing, and have really enjoyed it. And great perspectives from folks who, frankly, let's be realistic. This has not been the best year to be a college student. And so if you can help out folks who've been in that spot, I think that's worth doing.
So, Bill, a segue into our last question. Let's assume you're in front of a room of the next generation of leaders, and you want to leave them with one piece of advice as a leader of today. What would you say?
I think it's a lot of different things. It's being focused on continuous learning, seeking out mentorships, seeking out coaching, thinking for yourself, right? I mean, COVID taught us anything is that you really need to think for yourself. This was a very unusual environment. There's no manual on what to do during a pandemic, how to run a REIT during a pandemic. If there is, it's not on Amazon. And so you have to really think for yourself. Then there's all sorts of cliched things like be authentic and treat other people as you want to be treated. But really, this has been a great opportunity to continuously learn, to take the challenge that's in front of us, which is obviously something that no one was prepared for. Be really focused on what's in the best interest of your shareholders. That I think was some management teams really focused on that. Some focused on themselves. And then I guess the last thing I would say, because it's so hard to do that I don't think it's a trade secret that anyone can copy, which is it comes down to people. That's the most important lesson. It came down to the quality of the team members that we had, and that wasn't something that on, March 12th, when we knew that this was a problem, you could change. You had the team that you had. So really, really focusing on the quality of the people. Bill, you've done some searches for us. You know that we can be maniacal, unreasonable, whatever adjective you want, on how selective we are, and that really proved to be the right call. We went into this with world-class people, and that from on the investment side, that takes into we're probably talking to 40, 50 junior people for every one that we hire. We test people extensively. We put a lot of effort into mentoring, training, post-hire too. So if you don't have the right people, that's so hard to fix. And Carlos Brito, who ran Budweiser, has some great YouTube videos on this, speeches at Stanford and some other great institutions. But I take that really seriously. You have to have world-class people, and if you do, things like a pandemic you can deal with because they jump into action in ways in which is super impressive.
Well, Mr. Linneman?
Well, another great session, Bill. Bill, thank you so much for taking your time out of a busy day. We very much appreciate it, and I think going to be a lot of people learn a lot from this session.
Excellent. My pleasure. Thanks, guys.
Thank you, Bill.